Okay, it's a couple minutes past the hour, so I think we can get started. My name is Amanda Hopkins, and I am the Director of Operations for CCI Wealth Management. And on today's webinar, we will hear some post-election comments from our Chief Investment Officer, John Maher. I have compiled the questions that you all have submitted with your registration, and we'll ask those after John's remarks. Thank you so much for submitting those. Please note that all participants are muted, so if any additional questions come up during the presentation, please type them into the Q&A box. Take it away, John.
Thanks, Amanda, and thanks for everybody that joined us today. Did this a couple months ago, back in September. If you were here, welcome back, and if you weren't there, welcome to your first time. You'll see me look around. I have multiple different screens, and I'm renowned in the office as being a technology expert, not. So forgive me with the glitches that occasionally pop up. Listen, our goal is always to keep these Zoom meetings are more interactive. We have several questions, as Amanda said, that were submitted, and we thank you for those. But please, as we proceed today, if something specific comes to mind that you'd like to toss into the conversation, be my guest. I'd ask that you would be specific because a lot of people, as you can imagine, it's fully expected, have asked basically the same question since the election, which thankfully is behind us right now for the most part. And I'm sorry to be repetitive. I'm going to be a little bit repetitive today, but my job is portfolio management, and my job is definitely not political punditry. So I'm really not here to divine the political winds and all different types of policies that may result in the many months ahead. But really to talk about what's most salient to my mission, to our mission, which is portfolio management. And I realize we're in competition every day for your attention. We compete with CNBC, the Washington Post, the New York Times, Boston Globe, all of social media, CNN, ABC, CBS, NBC, NPR, et cetera, a host of other outlets. And obviously we're not broadcasters, so putting out a written piece as we have every quarter or so, and then doing this maybe every couple of months periodically puts us at a disadvantage. So I get it, sometimes we lose your attention. I know a handful of our clients did exactly the opposite of what we counseled back in March, and others made some drastic portfolio moves prior to last week's election. So I'll say this to you, keep one thing in mind. The advice that you get from the news outlets and from social media is generally free. 99% of the time it's free. It's been my experience that you're getting exactly what you pay for. There's no accountability to you. There's no accountability to your portfolio or to your retirement plans. So, when statements are emphatically made on, say, NBC or Fox Business Channel about the markets that turn out to be spectacularly incorrect the very next day, and no problem, our next guest says, and they trot out a different, conversation immediately. So we really constantly come back to this theme of just be very careful about making big portfolio movements based on all this media narrative, media comment, media opinion. It's not the declines like we saw in March, or even like we experienced in the weeks that led up to the election, that's going to kill your long-term returns. It's sitting out the rallies we had in the spring and the summer, and sitting out the rallies like we had over the last week that jeopardize your long-term returns. So I want to, in the spirit of being a little bit repetitive, just recap a couple of the most important points I made and find out, back in September, find out where we are right now, and then move on to your questions. First point I made, polls are often wrong. Polls are seemingly more and more wrong. They survey national opinion. They tend to include people who have no intention of voting. And there's a big difference between, a survey of adults 18 and older and a survey of likely voters. But polling is getting more and more difficult these days. I think the polling industry has done itself irreparable damage over the last 2 elections, and I would keep that in mind going forward. I made the point that the presidential election, well, I might even said this, the presidential election doesn't matter. I know I've been saying internally all the time, but I did make an effort to get the point across that the presidential election was really second in importance to the Senate elections. It's possible that the market's rally over the last week proves this point. The results of the congressional election are not quite settled, but they look to be settled in a particular direction. We'll find out, we'll certainly find out more in about 2 months. I made the point that the biggest risk to the markets, the biggest risk to the economy is the virus. It's not the election. And I think we saw this in October. As infection numbers rose around the world, but certainly rose in the UK and in Europe and here in the United States, we saw the S&P lost nearly 3%. The NASDAQ was down 8%. The markets, I don't believe, are falling because of politics. The markets, the polling numbers during that period of time, really was the second half of October, hadn't changed much one bit. In fact, they hadn't changed much since the beginning of the year. And I do believe going forward that the economy and the market is going to be much more sensitive to the advance of our fight against the virus going forward. Last point I want to touch on, again, to reiterate that monetary policy and fiscal policy stand far above political considerations and are both going to remain accommodative. We'll need to parse the degree of the amount of fiscal stimulus, perhaps, in the months ahead. And fiscal stimulus, while it will be coming, certainly was not forthcoming in the last couple of months, despite most expectations. But monetary policy and fiscal policy are the most important points. So that's just a little recap of what we talked about in September. I don't think any of that's been proven wrong. And Amanda, what is first on the list?
Thanks, John. So the first question that we have here is that it looks like a likely Biden win for the presidency. And if the Republicans hold the Senate, what does that mean to the US-China relationship? And will the US lose a chip supply to Huawei? And how does it affect our investment positions in China?
All right, so a three-parter to open up with. Said this before, I think it's worth repeating. I know we've written it in an Outlook or maybe two over the last year and a half. Tensions in the United States, tensions between the US and China, I should say, that is one of the very few bipartisan areas in US politics today. If Biden is now the president, there's reason to believe that the focal point of tensions could shift a little bit, but they're still going to be there. Whereas Donald Trump's focus on China was primarily encompassed in trade disparity issues, and I do believe Biden and the Democratic, party will continue to press China on trade disparity, fairness, etc. The tools used by the Trump administration were tariffs and export sanctions. So we might see a Biden presidency focus more on human rights issues, which is, by the way, something China definitely, I don't believe, wants the world focusing on. So the tensions will remain. I also think it's less likely that focus on tariffs, maybe perhaps a little bit more consensus building among our allies, could actually be net positives for our Asian or China-centric specific investments. Though I think the U.S.-China relationship is going to remain strained. Our exposure to China, our exposure in Asia is fairly insulated. It has been fairly insulated all along, even if the trade war continues. I mean, the focus is on organic growth. The focus is on technology, on healthcare, on innovation. And we own no exporting Chinese companies or no exporting Asian companies in our fund. So, I mean, I've found that even the supply lines for companies within the fund have been fairly insulated from the trade tensions. With regard to the question of US firms losing chip dominance to Chinese technology companies or China in general, I don't believe that that's going to be a concern in the near term. China has ramped up its own semiconductor industry amid the trade war. But the reality is right now, currently, and this is according to the Center for Strategic International Studies, 16% of the semiconductors used in China are made in China. And only about half of those are actually made by Chinese firms. But China contains some of the world's most innovative companies in the world. Many of them have become or are in the process of becoming multinational organizations. Innovation has been rapid and impressive in software, things like cloud-based computing, artificial intelligence. Hardware innovation like semiconductor chips has not been a focal point of Chinese innovation. So, you know, that may be different down the road, and perhaps the government tax breaks and other incentives seek to minimize that vulnerability. But in the near term, don't see that being an issue.
Okay, great. Thanks, John. Next question. Given the divided government, is a fiscal stimulus plan still possible?
Yes, let me preface this by saying it looks right now like we have a divided government. In other words, it looks right now that there's not a lot of change after the election, other than, you know, a slight shift in what color the executive branch is. Whether that holds will be, you know, time will tell. So I'm not going to try to predict that, but it does look right now that we have a divided government. And yeah, I think a fiscal plan still is possible. And in my opinion, it's probable. Possibly even in a lame duck session before the end of the year. But let me outline two things I think should inform our expectation. So you say divided government, you're assuming something that we cannot know for sure. And while I think everybody can agree that Democrats underperformed many expectations, as of now, there's still no decision in Alaska, I think recently North Carolina, Michigan, and of course, it looks like there's 2 Senate seats still up for grabs in Georgia for a January runoff. So we're not going to know the makeup of the government truly probably until the first week, end of the first week of January. But assuming what looks today like the likely results, I think you do get a COVID package passed now that the election is over. But I also think it's going to end up being much smaller than the last 1.9 trillion that Trump had agreed to. I'd throw in a couple bullet points here. Whether it happens in the lame duck session or whether it happens, you know, early next year. A couple things are worth noting. Number one, and this is something I think folks should keep in mind for any legislative possibilities. You know, you think of gridlock, you think of a divided government, you think of nothing possibly getting done. And Wall Street actually kind of likes that. But the fact of the matter is, keep this in mind. Joe Biden and Mitch McConnell, who is the Senate leader for the Republicans, actually have a pretty solid, pretty friendly and cordial working relationship. So I wouldn't be surprised to see the two sides find more common ground that was found between, say, the House and the executive branch over the last 4 years. The other thing is, I think if we can move beyond, I'm going to pull up a chart here. Hopefully everything goes smoothly with my technological prowess. Beyond the political question I think it's worth looking at some recent data. And it's just about a week ago, a little bit more. We got some pretty remarkable economic news that exceeded most expectations out there. It was predictably drowned out by the news coverage. Third quarter gross domestic product, right, GDP, initial estimates were released, and it showed a 33.1% rebound. Now, these are initial releases. It'll get revised something like 9 times over the next 4 or 5 months. But recall, going all the way back to April and going back to May, all the various suppositions of how or whether the economy might recover. There was talk of an L-shaped recovery or a V-shaped recovery or swoosh-shaped recovery. And, I think it's fair to say that the verdict is in. And clearly, and I think without any ambiguity, we have a V-shaped recovery. Most recently, Friday, unemployment numbers came in and were very impressive. I would also note that this is important because personal spending was another area that is most affected by an economy whose government shut down a vast swaths of the service sector. So taking a look at, if I could just broaden this out a little bit, taking a look at retail sales in the third quarter, it's worth noting that these developments occurred, and by the way, retail sales, personal consumption, up 40%, 40.7% in the third quarter. That's the vast majority of why GDP firmly exceeded expectations. But these developments happened despite the fact that there was no agreement on a follow-up fiscal stimulus plan by Congress, between Congress and the Trump administration, after it expired on July 31st. So I think, to be fair, there is going to be a stimulus plan, but there's also going to be a question about just how big does this plan need to be? Does it need to be $3 trillion? Or, some of the initial work being done, I think, by the House was as high as $4 trillion. They got it down to, less than $2 trillion and still couldn't agree on it. But despite all the predictions of Armageddon, and without another stimulus bill, the economic rebound, I think, is going to be continue and is going to be informative on what size of a fiscal stimulus we get. The other thing I'd make a point of is that, and again, another reason why I think you're going to get a fiscal stimulus bill is that the economy does remain about 3.5% smaller than it was at the end of last year. And while unemployment picture has been quite improved, much faster than most people expected, we still need to do things to avert a possible housing crisis in the months ahead. Rental projections or protections, enacted by both Congress and state legislatures expire at the end of this year, in some cases even before. So whatever form it takes, I think the bill is going to get passed. But remember, the midterm elections just began. That might be the biggest reason it gets passed. Question is when, of course, and for that we can only say we will see.
Great, thanks, John. The next question is: growth stocks have done really well the last few years. Is it time to take some of the profits and add to value or dividend stocks?
All right. This is a question that remains ubiquitous. It's been on the air. It's been in the air. It's been bandied about. I think it's the #1 topic to talk about this year, and it's not surprising. I mean, I'm serious. I don't spend a lot of time on CNBC, but I'll sneak off to lunch, hop in the car at lunchtime, and drive down to get a sandwich or something. And every single time, this entire spring and summer, when you get in the car, the debate on, I pick it up on satellite radio, is, is the growth stock rally over? Is it time to buy value stocks? You know, in 7 months of this, it gets a little bit crazy. As most of you know, the you know, middle of March, the Ides of March, if you will, we made a very large push in our equity allocations from value to growth. Actually, we already had a growth tilt. We didn't have a value tilt, but we, you know, we made a concerted effort to even emphasize that tilt even more. Probably the largest tactical tilt we've had in a model portfolio since I've been with the firm. And we outlined, you know, the many reasons we did it. I'm not going to rehash that here, but the results have been quite favorable for us. They've been so positive that after the initial weeks of favorability, it seems as though everybody's ready to unwind it. You may recognize this chart because I think we published it in our outlook going back to June or July, but this is in red, the large cap Russell 1000 growth index, and in white is the large cap Russell 1000 value index. And this goes back to call it the Ides of March, maybe it's a March 13th, 12th, something like that. And you see the outperformance is spectacular. I mean, these are price points only. It doesn't include a dividend, but the difference is well over 20%, well over 30%, excuse me, between large cap value and large cap growth. Now I've talked about prospect theory, right? And we did talk about this a little bit. Let me show you one other thing, actually. While that previous chart was large cap growth versus large cap value going back to March 15th, this is the last 7 years of the exact same indexes. Large cap growth being on top, large cap value being on bottom. Now, we did talk about back in September, prospect theory, right? Behavioral finance topic, and one aspect, you know, the results of the biases of individual investors is you have a tendency to sell your winners. You also have a tendency to hang on to your losers. You know, we've got still a lot of unsolicited pot stocks that are down 90 to 80, 90 cents, but clients insist on holding them. Yet, because your growth stocks have, you know, growth indexes have vastly outperformed your value indexes, there's a tendency, a propensity to let's get out. It's time to get out. You know, the other aspect of prospect theory is this notion of gambler's fallacy. All right, that's, you know, it's the notion that you understand that something's generally mean reverting, but you step in and you decide when that reversion is going to happen, and you can't possibly know. So we have an illusion of knowledge that we're going to be able to pick out when growth and value are going to flip. This has not been a 2020 phenomenon. This has been a 7-8 year phenomenon between growth and value, and there's a lot of various reasons for it. So I'll say this, when I say tactical tilt, and I'm speaking about our significant tilt into large cap growth back in the spring, it doesn't mean we sold everything. It doesn't mean we sold every value stock, mutual fund index, and put it all into large cap growth. That's not prudent. That's not what we do. I would say it's fair to say that it on average is about a 3-to-1 favor in favor of large cap growth. That's about where the weighting stands. I answered the question in September, should I get out of this market? The implication being, well, I've done well, I should sell. And this is a similar question. There's got to be a better reason than growth stocks have outperformed value stocks by such and such a point. It's time to reverse course. Our tilt to large cap growth is both strategic and fundamental. We are, you know, growth is the way out of any recession, and growth is also instrumental to our portfolios, you know, meeting a capital gain, you know, objective alongside dividends and income and other aspects. artificial intelligence, cloud computing, 5G, they're not going away. They're not slowing down. They're not slowing down. So if you believe some of the reason large cap growth outperformed the last 9 months was COVID related, I think about the lockdowns, the stay at home companies, if you will, the stay at home economy, the technologies that made this possible. Well, folks, the weather's getting colder here in the Northeast. The virus count is on the rise. Are these exactly the companies that you want to ditch, or if not ditch, significantly reduce? Now, narrative has it that a vaccine will rally, or that value will rally on a vaccine, and I believe there is some truth to that. But I think really we're probably 4 to 7 months away from a widespread ability to vaccinate large swaths of people. Last point on this topic I'd like to make is that we get into value traps. And sometimes, we fall into them. I think we might have we came close to falling into one anyway a couple of years ago with the financial sector. Value traps are buying stocks or buying, sectors that are cheap, that they have a low PE, or they have a high dividend ratio, or they've been beaten down. You buy them and with the expectation that, that's a contrarian move, they're going to rise. But sometimes they go down even further. And sometimes it may take quite a few years for them to rise. So we do keep our eye on the value growth performance disparity, but we have no near-term intentions of reversing that weighting. I guess another way to say that, and just one last thing before you jump in with another question, Amanda, is that we're going to be evidence-based investors. We're going to look for fundamental evidence before we make that kind of a move in the portfolios, rather than kind of following a narrative. Over to you.
Great, thanks for that clarification. Next question is, with yields so low, is it even worth investing in bond funds? And what should I invest in for income?
Well, we touched this topic a little bit in our last Zoom, right? In September. I think it's archived. You can go and check it out. But I'm going to agree that, yeah, obviously yields are way down, and when interest rates, the Fed funds rates are at 0, that suppresses all interest rates in the government markets, in the agency markets, in the corporate markets, right on down. But I'm also going to reiterate that investing for yield or investing for income in an environment that offers none can be risky business. And to be repetitive, to cover again what we covered in September, we are total return investors. Tell us what dividend, what yield your portfolio needs to produce, and if it's within reason, we're going to provide it. Whether it comes from a dividend, interest payment, or capital appreciation, for most people, at the end of the day, makes no difference. You figure out what the yield of your portfolio needs to be, how that yield is supplied, again, whether it's from dividend yields or capital appreciation, should make no difference. Investing for yield when there is none, again, tends to push people out on the risk spectrum. In the bond market, it tends to push people out on the way down on what we call the credit curve. Ultimately, and with into a high weighting of junk bonds or BBB bonds, or large sector of corporate bonds that might be at a higher risk to become junk bonds. In the equity markets, investing for yield and viewing everything through the prism of a dividend tends to have the effect of people buying a lot of value companies and judging stocks by dividends. We saw a lot of dividend cuts this year. So people who were investing with that as a primary methodology got hurt, and hurt badly. But even in our own portfolios, while we have this great large cap growth tilt, as I said, we didn't completely ditch value, but even the dividend yields there are not great. So you really do have to reach for yield, and it's dangerous. So the question of whether it's even worth it to invest in bonds, to that I have to say, of course it is. I mean, what's your alternative? Your alternative is to have no bonds and a portfolio of 100% stocks. And if you can talk yourself into doing that, you hopefully can talk yourself into, accepting that kind of volatility. Or your option is to go with a 0% cash yield, right? Money markets are, less than 10 or 15 basis points in a yield right now. So cash yield 0, 100% stocks, or buy bonds. Bonds, beside providing income, and while the income may be low these days, they also provide ballast to the portfolio. I want to be clear, when I'm talking about bonds, I'm not talking about buying individual bonds. And we'll maybe make this another topic for a different time, but buying individual bonds for investors, like individual investors, is a gargantuan mistake. But I'm talking about bond funds, diversified bond portfolios of one stripe or another.
And our last question was a very popular one. Are my taxes likely to increase in 2021?
I think the short answer to that question is no. And it goes back to the election. It's important to know, the narrative in a lot of corners, certainly in many, if not most media venues, seem to be this prospect of a blue wave. We know what one side campaigned on, and that was the fact that they were going to raise taxes and they were going to get this done, that done, and the other thing done with the revenue. The Associated Press just called the presidential election for President-elect Biden, if we could call him that. That was just yesterday. That is almost, that's 5 days after the election. Another way of putting that is this has been a close run thing. And the fact that we still have an unsettled number of complete counts yet to be made in the Senate shows that neither side won a mandate. So I would not expect I would not expect a President Biden to be able to enact much of what he campaigned on. I think we're going to be moving forward in inches, not in feet, certainly not in yards. Now, having said that, if you got a tax cut 2 years ago, I would expect that you're probably not going to have a tax hike in the near term. Remember, we have congressional elections again in 2 years. And looking out a little bit further, the tax cuts you got 2 years ago expire at the end of 2025. So I can say in the immediate future, I don't see a tax hike on the horizon. But moving out a little bit further than that, it becomes political again, and then you have the expiration of the existing tax cuts.
Okay, well, that's all of the questions that were submitted. John, do you have any parting words?
My parting words would be that I think it's important to understand, presidential elections as their effects on markets to the extent they have them. And to me, there's actually no evidence that there's been much of an effect on our markets for this presidential election cycle relative to the virus news. But what effects elections have on markets tend to be very, very short-lived. We're talking about weeks, maybe a month, and that's just history, folks. Beyond that, the markets care about monetary policy, fiscal policy. As we move forward, if we assume, dangerous thing to do sometimes, that we have a Democratic presidency and a Republican Senate. I would look forward to moving forward in inches with a Democratic president and a Republican leader of Congress that actually get along. They have a good working relationship. So the focus, and remember, the president needs to get his cabinet by the Senate. So if we are in fact faced with a Republican Senate come January 5th or whenever that runoff is, there's going to be a whole lot of compromise on the part of the Biden campaign. And I think that's going to continue to be a positive for the market, but focus on the Fed, focus on the fiscal stimulus, and focus on the growth in these markets. Where is the growth? That's what we're trying to do.
Great, thanks, John, and thanks to everyone for tuning in. Have a great night.
Thank you. Bye-bye.